Hey everyone, let's get straight into the topic without any delay. One well studied mistake will prevent 10 silly mistakes in the future. To me, a proficient trader is merely someone who has learned from their mistakes. They comprehend every facet of the trading model, including its strengths and pitfalls. In this video, I'll discuss one of the three models I typically trade. A simple, straightforward one. So here it is, introducing one of the simplest models I trade. Alongside, there are a few other concepts like weekly profiles and daily profiles that are crucial for trading this model efficiently. And I assume many of you are already familiar with these concepts. You might have watched it from other ICT videos, but I'll also cover them in my upcoming videos. Additionally, I'll be curating a playlist dedicated solely to this model. This playlist will feature numerous examples, including backtests, breakdown of my trades, analysis of losses and mistakes, aiming to prevent them from occurring in the future. So every high time frame PDRA gives birth to low time frame expansions. Every PDRA, every range on high time frame is going to do one of the two things. It's going to pay you or it's going to rob you. We are looking to extract percentage gain from every high time frame PDRA liquidity pool you see. This is our mission. This example is from May and June of year 2023. After reviewing this video, I encourage you to conduct a backtest on this example. Experiment with the replay button and you'll discover interesting insights for sure. For now, we'll focus on this specific area indicated by this black arrow. You see here. You see here we are in weekly discount area. Here is our order block defined by this line. It is important to know that every high time frame key level presents a trading opportunity itself. The goal is to extract a percentage gain from each high time frame key level. Now our overall drawn liquidity on weekly is this bearish OB and this external range liquidity. We can frame a 4-hour market maker buy model to this weekly external range liquidity from a swing standpoint of view. Before I show you guys 4-hour market maker buy model on the weekly OB to the weekly external range liquidity, I'll show a trade I executed using this straightforward logic that a 4-hour key level produces 1 hour and 15-minute candle expansions. As you see here, 4-hour swing low liquidity has been swept into this weekly order block, which I delineated earlier. This swing high is our safe target. We are not greedy like majority people. A high time frame idea executed on low time frame with a low time frame objective is my definition of high probability trade. So here, this is our low hanging fruit which we can target. You are not supposed to enter the restaurant and eat the whole menu. Take your meal and go home. After riding the 4-hour swing low into this weekly order block, we can observe 1-hour candle expansion. And in this 1-hour candle expansion, there will be obviously 15 minutes candle expanding. I patiently awaited for this candle closure above this bearish fair value gap. Once this bullish candle closed above this IFEG, inversion FEG, I waited and upon the opening of the next hourly candle, I anticipated a wick down as a Judas and I entered the trade at that point. I will zoom into the 15-minute time frame to show you the trade. Now I will zoom into the 15-minute time frame. I'll replay now. As new hourly candle opened here, it tapped into the IFVG and it underwent expansion. Our stop loss is relatively large and not tight because we cannot predict beforehand how much it will wick down before expanding upward. You can see 4-hour key level or a liquidity pool here gave rise to 15-minute expansions. This itself a model. You need to make money. So this is how it looks on hourly before we had taken our entry. And this is how it looks after it had played down. It has just wicked out into the IFG and it has expanded up. Let's see in this example now how accumulation of orders by smart money happens in 4-hour time frame on weekly key level. Or just to say in a simple way, like how weekly levels produce 4-hour candle expansions. In the upcoming examples, I will show you guys why it is important to take profits, shift in low time frame areas and not hold for high time frame targets, because often people jump in and take low time frame entry before high time frames above their entry time frame even got aligned. This may be because of the factors like greed and attractive risk to reward they may see. Before diving in, question yourself, who is the people that provide liquidity to the smart money? Those are traders who zoom into low time frame quickly and frame a trade there without waiting for the high time frame. The high time frames which is above their entry time frame got aligned first. This is also the reason you may see why your ICT concepts MMX model fails, usually because you don't understand accumulation and distribution. The accumulation and distribution is also called order pairing. Now what I mean by is, if you're framing a 4-hour setup on a weekly level to the weekly DOL in the premium, in this example currently we are discussing 4-hour market maker buy model on a weekly order block with a weekly external range liquidity. So you cannot zoom into hourly or 15-minute time frame and take an entry there to hold for the high time frame target such as weekly DOL. If you're just aiming for the low hanging fruit in the low time frame, it's fine, because you exit at logical area in the low time frame before price comes to your entry and stop loss area. So in this 4-hour time frame, we can frame a 4-hour market maker buy model to this weekly external range liquidity and also this weekly bearish order block in the premium. So we know already that weekly key level produces 4-hour expansions. If it is aligned with weekly and a monthly candle formation, we can aim for higher targets. So we are already in weekly discount and we have a nice weekly external range liquidity as a target. So this is after 4-hour market maker buy model has played out. We'll zoom into this smart money reversal area and we'll talk about accumulation here. So I zoomed into this 4-hour smart money area. This is how a novice or inexperienced trader might approach this trade. They recall a video where they learned that a weekly key level triggers a 4-hour candle expansion. So seeing the price tap into this weekly key level here and watching this 4-hour candle expansion with a FVG, they decided to enter a trade, setting the stop loss as shown in this image and intending to hold it as a market maker buy model to the weekly external range liquidity. However, it is not as straightforward as it seems. Let's observe what unfolds next. So his stop loss got hit and he's taken out of his position, and leaving him to wonder what went wrong. Understanding the logic behind how orders accumulate at key level is crucial. It's quite simple. If you are a part of an institutional group with a substantial orders, accumulating a large number of orders necessitates counterparties to be opposite side of your trade. They need to be selling to you for you to buy. How is this achieved? Institutions induce traders to open buy positions near the key level or at the key level only to trigger their stop losses. When the stop losses are hit, these traders are compelled to sell at market order. Consequently, institutions will place buy limit orders below the stop losses. As traders' long stop losses got hit, they are forced to sell at market order. Now they get paired with institution buy limits, enabling the institutions to keep repeating this process until they have accumulated desired positions. Price will react from a key level in three manners. It is either a V-shape reversal, M-shape reversal, or multiple taps. And scenario 2 and scenario 3 occur frequently. In the first scenario, being the most probable when there is a false break of structure that has previously occurred before reaching the key level. Multiple taps on key level are most prevalent when it's a higher time frame level, like daily or weekly. So here it is. This is when single tap of a key level is high probability. A fake BOS before hitting a key level, it will sucker in early buyers and it will hit their stop loss into the key level. This is when a single tap is gonna play, most probably. In this 1 hour time frame, another inexperienced trader is framing a 5-minute market maker buy model on this 1 hour FAG to these highs delineated with the green lines. And it will fail. It will fail because spot money has not accumulated enough long orders to start hunting this size and distribute their longs positions above this size. They are running sell side liquidity for now. They are running the lows and building the long positions first. They are leaving highs intact and building buy side liquidity, meaning they are leaving short stop losses safe here to distribute their longs after accumulation to the size later. But you see, these highs are not going to taken out as of now. But 1 hour FG still provided some 5-minute candle expansion. I said you before that 1 hour key level produces 5-minute candle expansions. So I zoomed back into the 1 hour time frame. You can see the trade has failed as we talked before. Remember, the lower time frame most of the time lies to you. The higher time frame often will expose it. This inexperienced trader zoomed into 5 minutes time frame and framed a market maker buy model aiming for this high time frame DOL even before high time frame got aligned. When is high time frame aligned? High time frame is aligned when enough orders are accumulated by spot money in that high time frame. Then we can zoom back into the low time frame to frame a entry to high time frame targets. When orders are not accumulated on the higher time frame, we should not zoom into the lower time frame and frame a trade towards that high time frame liquidity or high time frame draw on liquidity. So you can see traders on the both time frames got fucked up. You can see the 4-hour candle expansion after touching the key level. High time frame key levels often triggers multiple reactions. The market does not simply touch once and move on. Nonetheless, we can still profit from these reactions, as demonstrated in the first example before, where I took entry on 15-minute time frame after this 4-hour swing low, liquidity got rided into this key level. So after riding this 4-hour swing low liquidity again into this weekly key level, we can see a 4-hour OB was formed. We can frame another trade here and profit from it. What trade we can frame? We know that 4-hour key level produces 15-minute candle and 1-hour candle expansions. So we can take a trade here on this 4-hour OB during kill zone and can anticipate 15-minute expansions. It's always same sequence. Turtle soup, OB formation, expansion, retracement, then expansion again. We'll zoom into the 15-minute time frame now. So here I zoomed into the 15-minute time frame. You can see we made a 15-minute turtle soup in the 4-hour OB. This blue box is 4-hour OB. So we made a 15-minute turtle soup in 4-hour OB at the London kill zone. Time and price is aligned. So we can anticipate 15-minute expansions on 4-hour key level, which is a 4-hour OB here. So expansion. You see, we can take a trade here and put a stop loss here under the 4-hour OB. This itself is our trade. And we'll see what happens in New York. New York, it retraced back into 50% or 60% of the range. And it continued up. This is a classic buy day. London made the low. New York retraced into the London range, OTE, and it expanded to the liquidity. Beautiful trade. Just it is based on simple logic that 4-hour key level will produce 15-minute candle expansions. Turtle soup. OB was formed. We made an expansion. We retraced back. We expanded again. You can see we have taken some internal liquidity. And this internal liquidity also coincides with daily order block. So do you guys remember what I told you before? Daily key level will produce 1-hour candle expansions. So we can anticipate retracement here, or we can even take the counter trend trade. Counter trend trades are generally risky, but we can have a nice counter trend trade here because we have purged nice internal liquidity into the daily key level. I'll change it to the red color. So this is daily key level. So we can anticipate 1-hour candle expansions. New day open. OB is created here. So I'll replay it now. So you can see it's a nice move. Daily level, daily bearish order block. After purging the internal liquidity, gave a nice counter trend trade. Generally, I won't take counter trend trade, but I just want to show you guys how we can even trade counter trend moves. So I zoomed back into the 4-hour time frame. So you can see another 4-hour order block here. You can again anticipate 15-minute expansions here after touching this 4-hour key level. So I'll zoom forward. So there will be 15-minute candle expansions on this 4-hour key level. So you can see we rided a recept 4-hour swing low into this 4-hour OB. You can take trade right there, zooming into the 15-minute time frame. And we can take our profits here. Four-hour swing low merged into 4-hour OB. You can anticipate 15-minute candle expansions now. Or TP was hit. We are anticipating it to reach to this 4-hour bearish FEG. And so you can see for our rejection block here. I'll delete this weekly key level. So here is a 4-hour rejection block. When the price taps into this 4-hour rejection block, we can anticipate 15-minute candle expansions. We know that 4-hour key level will produce 15-minute candle expansions. So it tapped and it ran away. This itself is a trade. 15-minute candle expansion on 4-hour key level. So I zoomed into the 15-minute time frame. So this is the before trade we took on 4-hour OB, 15-minute candle reaction. I'm going to delete this. So this is our new trade. We are riding 4-hour swing low into the 4-hour rejection block. So it's a 4-hour key level and we can anticipate 15-minute candle expansions on this. Don't get scared seeing this. Smart money pair most of the times turtle soup with failure swings to scare off the dumb money who are lucky enough to buy this turtle soup. So turtle soups are most of the times paired with failure swings. And this trade was also taken in out of the kill zone. This was in London kill zone next day. So it did have a TP. So here in 4-hour OB, 15-minute candle expansion happened. Then again, we took this 4-hour swing low into the 4-hour rejection block. And again, 15-minute candle expansions happened. So this is another trade. I'll delete it now. See, you can see multiple 4-hour candle reactions on weekly key level. Here 1, here 2, here 3. We have seen lots of accumulation by stop running. Here one time, we ran this low into the key level. Then here one more time, and here another time. And this is turtle soup with fail using. See, we ran multiple times the lows in the key level, weekly key level. Most of the times, market will print bearish break of structures that discount to make you scared and induce you to take sell positions. And most of the time, market will print bullish break of structures in the premium to induce you to buy. So you don't buy fake BOS, fake bearish BOS, the discount or at the key level. We buy the lows when turtle soup happens. So I'll replay forward. You can see 4-hour order block here. They printed multiple times bearish patterns like bearish BOS, making you feel like you're not holding the weekly key level, seeing this big BOS. What they're doing is running the stops and accumulating the positions. They accumulated here, they accumulated here, they accumulated here. When they have accumulated enough positions, then we can go into the low time frame, frame it, entry in low time frame to target the high time frame DOL. So here multiple stop running, multiple accumulations, then we can anticipate the expansion is near because we have seen multiple stop running, positions are accumulated. So soon they will enter into the distribution phase. So if you can catch an entry in low time frame, when high time frame is aligned, you will get the biggest RR move. So I'm forwarding. You can see the move has happened after multiple stop running and accumulation. If you manage to get entry in low time frame here, when high time frame is aligned because orders are accumulated, so then when you can catch a low time frame entry here, you can hold for high time frame targets here. But people, what they do mistake is when market taps the weekly key level at first, they go here, put a buy limit and target this. But accumulations has not been done yet. So you cannot anticipate a distribution phase early on. You anticipate a distribution phase when there is a multiple stop running so that positions are accumulated. Then you can anticipate a distribution to the high time frame DOL. So the distribution started from here, 4-hour OB. So if you went here into the 5-minute time frame, 15-minute time frame, you can hold until your high time frame DOL because high time frame is aligned now. Zooming back into the weekly, you can see that weekly candles have respected this order block level. So you can see in each weekly candle, there will be multiple 4-hour candles. This weekly week, there will be multiple 4-hour candles. This is how it looks from 4-hour time frame. I hope you found some value in this backtest.